Why is it called Wall Street? Known as the heart of global financial markets, Wall Street possesses an intellectual and emotional depth shaped by various events and transformations throughout history, beyond being the center where trillions of dollars of wealth are directed. Wall Street's past holds extraordinary stories and instructive historical financial examples that shaped the market as we know it. How did Wall Street, with roots dating back to the 17th century, gradually evolve from a neighborhood into the center of world trade? Here are stories from Wall Street's history that will serve as proof of finance's resilience and adaptability. This article, full of unforgettable behind-the-scenes events on Wall Street, will shed light on the magical world of money. Why is it called Wall Street? The area's first name was Valstraat, Wall Street, named after the wall built by the Dutch settlers who first settled in the region to protect the city of New Amsterdam from attacks. The street was used for a time as a slave market and later became a place where merchants bought and sold goods. The financial origins of Wall Street, which is actually narrow and small in reality, but now encompasses the surrounding financial institutions that spill beyond the street itself, are equally striking. From a sycamore tree to a global center. In 1792, the foundation of the New York Stock Exchange was laid through an agreement signed by 24 brokers and merchants under an American sycamore tree. This agreement, which went into history as the Buttonwood Agreement, established the foundation of a structured securities market and transformed Wall Street into the bustling financial activity center it is today. The purpose of the agreement was to adopt a liberal credit policy and prevent speculators from influencing the bond market in response to the first economic crisis that occurred during George Washington's first U.S. presidency in 1792. The crisis atmosphere resulted in attacks on banks and panic selling in securities. As the number of New York brokers grew, Wall Street's Tontine Coffee House became the new center of operations. The crash of 1929. How did financial regulations come about? In one of the most infamous events in Wall Street history, known as Black Thursday, $4.2 billion in 1929 prices was wiped out, and this event also triggered the economic downturn known as the Great Depression, which continued throughout the 1930s. This crash exposed the vulnerabilities in the financial system and led to significant regulatory changes, including the establishment of the Securities and Exchange Commission in 1934 to supervise and regulate the market. The events of this period laid the cornerstones of today's financial regulations. Following the Great Depression, the Glass-Steagall Act was passed in 1933 to regulate financial markets. Named after Senator Carter Glass and Representative Henry B. Steagall, this law separated the activities of commercial banks accepting deposits and making loans from those of investment banks buying and selling stocks and bonds. In other words, it restricted the same bank from having the authority to collect deposits and to make investments, with the aim of preventing banks from endangering their customers' deposits by making risky investments. Insurance of bank deposits also began during this period. An important motivation for the law was the desire to restrict the use of bank credit for speculation and direct bank credit towards areas that Glass and others considered more productive, such as industry, commerce, and agriculture. This separation was abolished in 1999, but Glass-Steagall is known as a landmark regulation in banking history. Among its important provisions was the creation of the Federal Open Market Committee, FOMC.
However, although the 1933 FOMC did not include voting rights for the Federal Reserve Board, which were revised by the Banking Act of 1935 and changed again in 1942 to more closely resemble the modern FOMC, the law had a major impact on the Federal Reserve. The petrodollar and its global effects. The petrodollar, meaning the U.S. dollar used in oil trade, refers to the dollar revenues earned from oil sales, particularly by oil exporting countries in the Middle East. In the 1970s, it was decided that oil would generally be sold in dollars. This decision, which further strengthened the U.S. dollar in world trade, forced oil importing countries to hold dollars in order to purchase oil. Petrodollars were typically reinvested in international financial markets, playing a major role in the global economy. In the mid-1970s, the oil crises of what are now OPEC countries and the rise of petrodollars left a profound impact on Wall Street. While sudden increases in oil prices shook economic balances, they strengthened the role of the dollar, or the petrodollar, as the global reserve currency. During this period, volatility in energy prices and the role of the U.S. dollar in international trade influenced Wall Street's strategic thinking. The rise of modern trading, the boom of the 1980s. The 1980s witnessed a dramatic transformation on Wall Street, marked by the rise of investment banks and the emergence of modern trading technologies. A major shift in U.S. economic policies, known as Reaganomics, named after then U.S. President Ronald Reagan, encouraged investors on Wall Street with free market policies and low tax rates, contributing to the growth of financial markets. During this period, the popularity of stocks and bonds increased, and Wall Street's position as an international financial center was strengthened. This era was epitomized by the story of Michael Milken, known as the junk bond king. Milken's innovative use of high-yield bonds revolutionized corporate finance, enabling companies with lower credit ratings to raise capital. Despite the legal troubles that ultimately led to his imprisonment, Milken's influence on the development of Wall Street is today widely accepted as undeniable. The Japanese economic bubble and Wall Street's worldwide effects. In the late 1980s and early 1990s, the Japanese economic bubble and the subsequent financial collapse had a global impact on Wall Street. The tendency of Japanese banks and companies to overlend and speculate caused imbalances in international financial markets and reshaped the risk perception of global investors. The 2008 financial crisis. The 2008 financial crisis was another defining moment for Wall Street, triggered by the collapse of Lehman Brothers and the subsequent meltdown of the global financial system. This crisis exposed the dangers of the complex web of subprime mortgage loans and financial derivatives. In the aftermath of the crisis, large-scale government bailouts were enacted, and the Dodd-Frank Act came into force, aiming to increase transparency and reduce risk in the financial system. This program, also known as TARP, Troubled Asset Purchase Program, aimed to provide liquidity by purchasing banks' toxic assets. Wall Street began to recover thanks to this program, but the crisis caused billions of dollars of damage worldwide. The Bitcoin and blockchain revolution. On the other side of the 2008 crisis, the rise of cryptocurrencies and blockchain technology caused significant changes on Wall Street. Bitcoin and other digital assets gave rise to debates and uncertainties regarding regulation and the future of traditional financial markets. In addition, algorithmic trading became increasingly popular, enabling faster and more efficient stock trading, but also potentially increasing market volatility. Looking ahead, Wall Street is embracing the trend of cryptocurrencies and blockchain technology, as digital currencies such as Bitcoin and Ethereum attract interest as alternative investments that challenge traditional financial systems. The integration of blockchain technology promises to bring greater transparency and efficiency to financial transactions, signaling a new era for Wall Street. Conclusion: the future of Wall Street. From its humble beginnings under a sycamore tree to its role in shaping the global economy, Wall Street continues to remain at the forefront of financial innovation and transformation. Understanding these remarkable stories and historical financial examples provides valuable insights into the ever-changing landscape of the financial center. Let us not forget that the future of this street will become even more interesting with technological innovations and sustainable investments. The future of Wall Street, shaped by regulations and technological innovations, will continue to be instructive and inspiring for future generations as well.